Hello and welcome to GCV Analytics webinar. Today we are going to be talking about the industrial sector, and we are very pleased to have as a guest speaker Dr. Bernhard Mohr, Managing Director of Evonik Venture Capital. Bernhard has been running Evonik Venture Capital since 2012. And he previously worked at BASF's venturing unit, as well as BASF Corporate. BASF is another leader in the chemical industry based in Germany. Bernhard has studied chemistry at the University of Stuttgart and the University of Cincinnati. He also holds a PhD from the Max Planck Institute for Polymer Research in Mainz, Germany, and he's got plenty of postdoctoral doctoral degrees and studies. Bernhard, great pleasure to have you here today. Welcome.
Kaloyan, my pleasure. Thank you very much.
All right. So before we go into the heart of the webinar, I would like to give the word to our editor and founder-in-chief, Jim Mawson, for a few brief introductory remarks. Jim.
Brilliant. Well, thank you, Kaloyan, for that introduction, and thank you, obviously, once again for organising this webinar. It's really great insights that you developed through looking at the sector each month through global corporate venturing, and being able to get the insights and thought leadership from you, Bernhard, is truly a pleasure and an honour. So thank you from me for being able to join this webinar. So just a quick background. Obviously, global corporate venturing is the main publication we do, looking at how corporations invest in startups either directly or indirectly through VC funds as a limited partner commitment, but also the broader corporate venturing ecosystem, the accelerators, and how the entrepreneurship is done within the corporations. And that's allied to our sister publication at Global University Venturing, a new one that we've been developing around the impact space, how the sort of environmental, social governance issues are starting to really come through in terms of how people develop their venture investment portfolios, not just from corporations and universities, but more broadly through family offices and foundations. Global Corporate Venture obviously does the GCV Academy, run by Paul Morris at different locations around the world. And the GCV analytics that Kaloyan has been running takes the data, who does corporate venturing and what deals are they actually doing, and turns that into insights that people can actually use as a service. And that is all part of the overall umbrella that we have as the Global Corporate Venture and Leadership Society, where effectively the top 20% of the 2,500 or so corporations who invest directly or indirectly in startups come together and show what the leaders of the industry are doing to support the entrepreneurs in their 5 primary needs. Obviously, entrepreneurs are looking for capital, customers, product development, hiring, and an exit. And corporations are uniquely well placed to be able to assist and help not just the entrepreneurs and their parent corporations, but society as a whole become a better place. So next slide, it will give you a quick sense that the leaders also come together through understanding the data and the information that we publish at globalcorporateventuring.com, come together to meet up in our sort of main continental events we do in Brazil for Latin America, California for North America, UK for Europe, and Hong Kong and Japan for Asia. They come together to meet up in the local ecosystem. This is about $10 trillion of aggregate annual revenue from corporations who attend our US conference. It's about 200 billion of venture assets under management, and nearly 1,000 people now come together. We've just finished our Israel event. We're doing a networking reception in partnership with IESE Business School in Spain later this month on the 27th. So people from the community are welcome there. But our next big conference that we'll be doing from a continent-wide perspective will be our GCV Symposium in London on May 22nd, 23rd. The theme or focus of that event is very much looking at some of the disruption or turbulence that the industry will start to come towards, some of the headwinds that they're facing in terms of geopolitical risk, obviously where we are in the economic cycle, as well as some of the disruption affecting, obviously, industries through the entrepreneurial actions and endeavours that we're seeing. So please, you'll be welcome to there. The second quarter discount will end at the end of March, where you can save 23%. So, Kaloyan, next one. And we're delighted at the symposium to welcome people like Jeffrey Lee, managing partner of Tencent, and you'll be able to meet in person our star guest from Evonik, Dr. Bernhard Mohr, who will be able to share some of the insights he's presented in the webinar in person as part of a discussion at the symposium. But we're looking forward not just to those leaders, but a whole host of others. So if you're interested in learning more from the data being presented at this webinar, or more broadly what we're doing, members of the Leadership Society are able to use the GCV Connect platform to connect to their peers. The GCV Analytics, which powers the understanding what the industry is doing, is presented by GCV Analytics in partnership with Cubics Analytics, which helped develop the software. So please don't hesitate to get in touch through info@globalcorporateventuring.com. Kaloyan, over to you, I think.
Thank you very much, Jim. So let's get right into the data on the industrial sector. Before we do that, I always like to explain to the audience how we define each of the sectors that we look at in our monthly magazine. So the industrial sector, according to the definition that we use at GCV, encompasses things like manufacturing equipment, artificial and advanced materials, industrial chemicals, including specialty chemicals, 3D printing, in other words, additive manufacturing, robotics and automation, along with unmanned aerial vehicles, or just more colloquially known as drones. Then we also include agriculture and agtech, which may, from a broader historical perspective, seem a little strange, but as the agricultural sector over the past century and a quarter, has been heavily mechanized and industrialized in a way, we also think it's appropriate to put it together along with the rest here. And of course, we consider also other industrial technologies and applications in things like mining, construction, and so on. When we talk about general trends in the industrial sector, I guess the two main buzzwords that come to mind are Industry 4.0 and the Fourth Industrial Revolution, that kind of thing. Those are hypey journalistic buzzwords, but I don't think they're necessarily bad buzzwords, because ultimately they do describe the sort of blending of industrial power with the force of IT. And other tangential technologies, and a sort of an ongoing process of digitization, which is being seen in virtually every sector of the economy nowadays. So I think even though we have to be careful with hype and buzzwords, they're not necessarily bad. However, along with the hype, there's also been some turbulence. Further to your point, Jim, there have been certainly rumors of setbacks and retreats of some major players like GE Ventures, which is rumored to be seeking to effectively sell out its portfolio and its asset, while part of its venture portfolio will be taken over by GE Capital. Now, this, it's not entirely official yet, but this is certainly being rumored. And in an economic environment where we seem to be heading for a sort of an economic downturn, this sort of development does seem to be inevitable every once in a while, particularly in industrial companies or in other companies from other sectors that may happen to be in a troublesome situation, in dire straits. so to speak. However, on the line with us, we have Bernhard, whose portfolio, whose total assets under management have been increased fairly recently. So far from the unit being dismantled or being threatened, Bernhard, recently you raised a second fund. Would you like to share with us and with the people who are listening to this webinar and who see it on YouTube later on, what are some of the things that you guys have done well at Evonik and at Evonik Venture Capital in particular to prepare for such an eventuality and to prepare well for it in order to continue to function?
Yeah, Kaloyan, very happy. I think first of all, I would like to make a statement that even in a situation of economic downturn, innovation activity continues. And I think it's even more important in such a situation to really to get access to interesting innovation in order to stay competitive and to work with startups. But of course, I think this is the venture capital view, and this is a view you also need to communicate and transport to the broader organization and especially to the board. So for us, key certainly was to keep very close contact with our key stakeholders over the years of existence, and key stakeholders here are the board. Of course, you need to show successes, financial successes, and also strategic successes. And one of the success we had last year is we acquired one of our portfolio companies that was a very good story to show to the board that through an investment we have a very strong access to good innovation. And finally, I think it's the team. I think the team, the venture capital team, are ambassadors to the company. And over the year, we have built a team of people that come from the inside and the outside. So for us, it was very important to also have people in our team, have been in the company for many, many years, that were able to really also have a good network and bring a lot of strategic value throughout the organization. And this enabled us to go to the board end of last year, where we already had a situation where everyone realized that the economic future, we might want to face some downturn, and we were able to really get new funding. And you mentioned this, it was not only get new funding, we were able to more than double our fund volume under management.
Right, and that's quite an achievement, particularly within the context of a potential downturn, and already some might even argue an ongoing, slowly lurking downturn. And also in the context of some of your peers having seen quite a few changes in terms of people's moves within the team. And I mean, you could look no further than Siemens, which is from your native Germany, where there were quite a few people's moves last year, and people could read up more on that in our monthly magazine. I'm not going to enter into details, but from a broader perspective, it does seem like you have a stable team, and you've got an additional funding, which I think is quite impressive. And I thank you on behalf of all our listeners for sharing those tips on how you've engaged the board over the years, and how you've actually had something to show before asking for more. So I think that's very, very valuable. On to the rest of the presentation. So Some of the major technologies that seem to have emerged over the past couple of years and are in an ongoing ongoing concern, ongoing interest in the industry. In the first place, we have 3D printing or additive manufacturing, which it may have failed to deliver on a promise from the past to turn every home into a factory kind of thing, but it is still considered an essential ingredient by most analysts of what we call Industry 4.0. And even though most 3D printers work with plastic, there is definitely a push and a significant drive to design 3D printing technologies using other materials such as iron or some sort of alloys or any other materials really. So that's one very interesting area. Another very interesting area is unmanned aerial vehicles or drones. Whereas in a report by Goldman Sachs, it was stated that the global spending on drones will surpass $100 billion by the end of 2020. Now, this does include some non-commercial drones, obviously within this estimate, but most of the drones being used as of today are actually are either industrial or commercial in some sense. They're not being used by just regular folks who like to do video around their neighborhood or around the park. So drones have had a significant impact in certain industries like construction, agriculture, surveying, mining, real estate, and that impact is fairly noticeable there. There's probably going to be even more impact in things like transport and logistics and supply chain and moving of goods kind of thing. That's what we could expect going forward. And of course, when we speak of drones, we can't just forego speaking of robots and robotization and automation, because it does seem like the current drive for automation comes particularly from the automotive industry more than from any other industry at the moment worldwide. But I believe there is an overall drive for automation across virtually every industry, as this streamlines operations. It brings about further efficiency. So it's no wonder that some predict that the use of robots will accelerate at about 24% by 2023. Then the average density of industrial robots around the world is around 57 robot units per every 10,000 workers. So we're still far from a bleak future where robots just replace people altogether in the workplace, but there's definitely this trend. So Bernhard, I would like you to comment on these three big trends and how you've been seeing them from the standpoint of an investor. Have you invested in any particular companies in those areas? And if so, what has your experience been, and what is your point of view on each of the three?
Yeah, maybe let me start with robots here. Sure. I probably would go a bit further. I think robots, I would say it's automation and this is artificial intelligence, and one of the themes that we will be addressing also with the new fund is this very topic of digitalization in the chemical industry, and we see this across the value chain. So we see this, of course, in our production. We see it in logistics, but we also see this in administration processes. And To give you some very concrete examples, we haven't invested in these type of companies. We, for example, look at this point in time at startups which have exoskeleton type of robots. So there are many things where we think there also could be a lot of potential for the chemical industry. Same holds true for drones. We are not engaged in manufacture of drones, but of course drones can have a very important role in the chemical industry. So what we do here, and this is also part of our venture capital activity, is really bring drone company in Evonik, and these companies then seek applications drones can have, and we are already actively using drones. We are in contact with a significant number of startup companies here. Will this be an ultimate investment? I don't know, but startups play a very important role for us. And when we come to 3D printing, we are one of the largest producers of powder for 3D printing. And the company I just mentioned, we acquired Structured Polymers, a US-based company, is a company that has developed a new process for 3D printing materials. And 3D printing is also one of our most active fields. We have another company in due diligence in this field. And I do expect that this also will be a very active field for the next 18 to 24 months. So it's already a bit crowded, but we still see very interesting opportunities arising there. And I'm sure that we will be doing additional deals in these areas over the coming 18 to 24 months.
When you say it's being crowded, do you mean that you have been seeing valuations of such startups go up or drastically or anything or being crowded just in the sense of there are way too many startups that are competing in this field?
Well, I think crowded typically has a negative notation, and if we go a couple of years back, I think there was the OLED industry and carbon nanotubes. Some of us might still recall this, and this was crowded, but this was crowded in a sense that people did not know who will be the winner. And I think, for example, in carbon nanotubes, there was a feeling that there can be only a very limited number of winners. I think there were many companies, the field was very thin. I think there are so many applications for 3D printing, so many different industries, so many different materials. 3D printing now go into life science. They go into industrial parts. So I would say crowded here in a very positive way. There will be not a single winner. I think there can be dozens of companies existing alongside, and many of these companies can get to really relevant revenues and even becoming unicorns. So I think this is very positive. There's not much of a concern. There will be only one winner, and then you need to place many bets in order to hopefully include the winner. I think there are so many interesting technologies out there for different applications using different materials. So it will be interesting, and it will be a good field also for new entrepreneurs to embark and make their technologies and their businesses successful.
I see. Well, and regarding other general trends in the sector, as I mentioned, we also consider agriculture here within our analysis of the industrial sector. So what we've seen is in recent years is the rise of agtech and what many people have dubbed precision farming. So this has certainly been driven by people's expectations on the challenges that the agricultural sector will have for feeding the world's population within the next 25 to 30 years. There's one report that forecasts that global farming production will have to increase by 70% by 2050, which, if you think about it, is not that far away. It's merely 30 years from now, to meet the demands of the growing world's population. And if on the top of that you combine things like arable land depletion, certain stagnation in developed markets of agricultural production, certain problems related to subsidies and that kind of thing. There's plenty. It seems like there's plenty of challenges ahead of us. And what precision farming does essentially is blending the power of IT and the power of the sector that's been feeding us for pretty much as long as there's been human race and human civilization, right? It seems to be a sector where there is going to be still plenty of opportunities for innovative startups to shine and to generate revenues and get traction and really make a difference for our world if we really think about it. So far from agriculture and taking off from the land, so to speak, if we go into the space and satellite tech tech realm, we see that there's been a record number of satellites. 345 were launched in 2017 alone. So basically, long gone are the days of the Cold War when space tech and satellite tech was the exclusive domain of pretty much the Soviet and the U.S. government. Nowadays, you could launch satellites. Even private organizations and universities could launch satellites, some of which are about the size of a shoebox. And most of these satellites, about half of them are observational. So there are a lot of applications for surveying and other industries, including agriculture, by the way, here. But there's also what's also worth mentioning is that in the rather short term, we will see probably another surge of satellites, or we will see this trend continue because of the trend of low orbit satellites, some of which are expected to provide the 5G connectivity that telecoms are about to roll out, about probably a year and a half from now. So this trend is set to kind of really deepen in that sense. And finally, the chemical industry. In this case, we're really lucky to have Bernhard here on the line with us. The chemical industry has been facing a whole huge set of challenges, from anything from declining margins to product commoditization, rapid expansion, customers demanding more at lower prices. Basically, overall, not a very promising picture for the entire industry. And on top of that, the chemical industry has been one of the parts of the industry and the broader industrial sector that's been perhaps the slowest. I think, Bernhard, I think that's fair to say, perhaps been one of the slowest ones to get digitized, or to sort of try to jump on the digitization bandwagon that pretty much every other sector is trying to jump on, right? That on the one hand, that seems a little gloomy, right? But on the other hand, you could interpret it as there's going to be plenty of opportunities for startups that want to work with incumbents in the chemical industry to bring in more innovation and to find opportunities there. So, Bernhard, do you share this view? What is your stance on the matter? Because you understand the chemical industry way better than I do. So I'd like to hear your position on it.
Yeah, I think I would fully support your analysis and what can you do to really overcome this challenge? One thing, of course, is to do a very active portfolio management. This is what we do from a company perspective. We acquire new businesses with high margins and we just divested a very interesting business, but more on the commodity side. So I think this is from an overall company perspective, just manage your portfolio. Of course, what you also need to do, looking at your portfolio, is focus more on high margin specialties. You need to consider new service models that also go beyond materials, and of course, relevant here is to stay competitive and to continuously improve your processes and your products. And all of these three things, startups can play and do play a very critical role. So just to give you one example, new service model, digital, you said we are a bit slow. You might be right, but one of the investments we did very recently was a UK-based a company called Optifarm. They are active in the digital farming space. So this certainly is also a key area of interest, and we do find interesting startups. The chemical industry certainly was not a front runner when it comes to digitization, but we are on a fast track here, and just to give you some numbers, at this point in time, more than 20% of our deal flow is geared towards digital opportunities, and these digital opportunities really go across all areas of our portfolio: products, processes, but even administrative processes. So we currently also look at the blockchain company. So
I see.
We might have been a bit slow at the beginning, but I can tell you now we are looking at full steam for digital startups, and we have a very strong acceptance here as people in the business to fully understand about the potential of digital startup companies, and especially their ability to scale very fast. Typically, if you look on a more materials-based company, it takes many years to go from a prototype to a final product, easily 5 to 7 years. And what you see in the digital industry, it's probably more 2 to 3 years. So we all have realized this, and this is why we are looking now very intensively also at digital opportunities, and we have done three investments last year on the digital side, and we will continue here.
Right. So it's great that you can find such opportunities within a significantly shorter investment horizon, and which you could bring on board, and which you could even potentially showcase to your board, right? So I guess that does make ultimately all the difference. Right.
Yeah. Maybe one general comment. Interestingly to me, when you talk about general trends in the sector, and I know you very recently also did the webinar on transportation, we keep getting a lot of opportunities in the battery space. So for whatever reason, this space is really accelerating again. We have seen battery materials as a very hot topic, I would say 5 years ago. Then it slowed down, and there seems to be literally we are seeing a battery company once a week. So this is also a trend we are seeing, and I think this certainly also comes with all the trends that have been discussed when you had also Uli Kwai from BMW. I think from the material side, people seem to increasingly engage in this field.
Right, I see. Well, I mean, the battery space is certainly attractive to a vast array of potential investors because of the potential impact it could have on whether it's things like autonomous cars or even things like the electric grid when it comes to producing sort of a stable current off of certain renewable energy sources and that kind of thing. So would you tell us very briefly what is the kind of what are the major trends within the battery space, and what are the kind of major major materials being used and being employed there to innovate there?
It's very difficult for me to say who will be the winner. The winner.
No, just the
increase. Yeah, no. I think it's again on efficiency, and it's on lithium ion. So we have seen a couple of companies on the breakthrough side here. We have been active in the field operationally a couple of years ago, probably too early. So this is why we decided to drop out. But difficult for me to say where this will go, but I can just say there is a very strong interest here at this point in time. All these companies also get funding, and materials will play an increasing role here.
Mm-hmm. All right. So I guess we could go on to the data right now. Before I do that, I would just like to remind the people who are attending the webinar at the moment that you could leave your questions on the window appearing on the site. Once we are done with the slides and with a general discussion on the sector, we're going to have a Q&A between me, Bernhard, and Jim. And if you have any questions, we'll be more than happy to take them and to answer them on the go, kind of thing. So onto the data right now. We saw 277 deals backed by industrial corporates. For the period between February 2018 and the end of January 2019, obviously the top market where the top geography where industrial corporates were investing was the U.S. with 125 rounds that we reported there. Other top geographies were China with 28 rounds, India 13, and Israel with 19. Or less. If we look at a breakdown as to what startups industrials have been investing in, more or less all of it kind of makes sense because the majority or a significant part, 72 rounds, went into industrial startups. Those were mostly either 3D printing, drones, robots, or advanced materials of some kind, as well as agriculture. On the IT side of things, industrials seem to be investing very much in big data analytics and artificial intelligence applications, as well as in cybersecurity, as the digitization of the industrial sector and the rise of the industrial Internet of Things, that's going to require significant capital outlays on the cyber security side. In terms of transport, the main areas of focus, quite predictably, we have investments in autonomous vehicle technologies, electric vehicle technologies. We've got also quite a few investments on ride-hailing, ride-sharing, and also that kind of area, which seems to be still kind of booming in terms of valuations that are fairly high around the world of startups providing such services. Then some of the industrial conglomerates traditionally also invest in the health and life sciences space. Actually, probably the first name that comes to mind is here is GE, really, because they traditionally and historically they have done quite a few deals in the health and life sciences space, but it's certainly not only GE. There are other industrial concerns and industrial conglomerates that are looking at this area, and then of course energy with batteries, as Bernhard mentioned. If we look at the co-investments, there's a fairly wide range of enterprises in which industrial corporates co-invest in together. So there's definitely drones, such as startups like Airware and Precision Hawk. There's definitely robotics. We have Sarcos Robotics here, where Caterpillar, Schlumberger, and GE co-invested. We have IoT applications and IoT networks, perhaps I should say, with Foghorn Systems and also Sensoro. We have big data analytics and AI, so definitely startups like Element Analytics and Bonsai, even things like energy and smart grid, like Ambala Power Networks and Actility, among many others. So a fairly broad range of technologies that have piqued their interest. And indeed, investments of industrial corporates have gone up on a year-on-year basis. If we have a look at the 2017 and 2018 figures, the number of rounds has gone up from 244 to 270, and that's still an increase, a statistically significant increase, but it's nowhere nearly as much as the increase of total dollar figures. And these are total dollar figures in the entire rounds. These are not money invested just by the corporates. So that's gone up from 8.7 billion to over 14 billion in 2018. As this shows. So this does reflect the general trend of valuations going up. And to be fair, this has been somewhat these figures have been somewhat influenced by investments in things like ride hailing and even certain healthcare or service sector companies, industrials may have invested in this space. So it's not necessarily core industrial investments that have driven these figures up, and that's an important point to make here. The top investors over the past year, in terms of number of investors, we had Airbus, Siemens, Sumitomo. Also, manufacturing groups like Fosun, Mitsubishi, Koch Industries, Axis Industries, as this graph aptly shows. In terms of corporate investors from the industrial and other sectors, we have Boeing, Airbus, even names like Alphabet, Baidu, Intel, Tencent, Haier, that are, some of them are internet companies, others are kind of more on the consumer electronics side of things. SoftBank, because of the SoftBank Vision Fund, which is investing across numerous sectors. So it's quite interesting to observe a lot of players from different sectors. And Bernhard, I'd like to ask you, so what are the kind of corporate co-investors you've been dealing with over the past year or the past few years? Let's say, what are some of the other corporate peers you have done a deal with?
We would typically always syndicate with other investors. This could be financial investors, but we are also not shy at all to invest alongside other strategic investors. So we have invested alongside our direct peers. One example is BASF. We have invested alongside BP, Shell, Sumitomo. So there's a long list, and this is also what I do see as a pattern. When people are doing investment, they look up to build a syndicate that could bring additional value across the entire value chain. And this is what we also do. We deliberately seek for co-investors also on the corporate side, which can bring some complementary expertise and value to our portfolio companies. And I would say roughly, if I sum up, we probably have 25 to 30 companies on the strategic side as co-investors, and we probably have roughly the same number of financial investors we partner with.
It's very interesting. Thanks. And if we look at the evolution of industrial sector startups, how they divide sort of by subsectors, we see that there's definitely been a surge in agtech, along with robotics and drones. Also, 3D printing remains quite stable and quite interesting to investors, as this graph shows. And in the past year, a kind of a surge in space and satellite tech as well, because as I mentioned earlier, this is probably due to the fact that satellites are becoming increasingly more in demand with the rollout of 5G technologies and so on. So on to the co-investments in industrial, in what we call industrial startups. We see, as it's evident from this very small, really spider chart, if you think about it, because we've got merely five startups here where we see a broad range of co-investors, a really broad one here. And it's really main technologies like drone tech and 3D printing that we're showing here, and we see how broad the range of co-investors really is. It's not just industrials like Koch Industries or Caterpillar or DuPont. It's also you have also Panasonic, you have energy corporates like Saudi Aramco, you have Microsoft from the IT side, you have Rakuten from e-commerce, also from the IT semiconductor side, you have Qualcomm. From the media side, you have Comcast, and so on and so forth. So it does. I think this slide does actually summarize in a way, in a very brief and visual way, how interesting current developments in the industrial sector actually really are. In terms of the top deals that we've described in our monthly issue, these are the top 10 deals. No deal above 1 billion. But just to mention a few of the top ones, we had the manufacturing group Fosun backing a 700 million deal in bike rental platform Hello Bike in China. We had Koch Industries buying a stake for about $500 million in an image depository site Getty Images. So definitely not a core investment there, but a very significant one dollar-wise. And then of course we had Access Industries backing Open Door, which is a real estate kind of service provider. We had a $300 million round raised by Israel nanotechnology startup Landed Digital Printing. It develops nanotech that actually helps improve the quality of printing. So and so on and so forth. I'm not going to go into details for each of the rest. Anyone can find the entire description of these deals in our on the pages of our magazine. But just wanted to note a few of the top ones here very briefly. In addition to deals, we also try to follow some of the exits, some of the exits corporates are involved in, whether they're involved as exiting investor or whether they end up acquiring a company that's been previously backed by them or by another corporate. So what we saw were 21 such exits for industrial investors in around the world. 11, some of them. So we saw 11 acquisitions, 8 IPOs, and 1 merger among those. And remember that this is between January this year and February last year. So if we look at it on a yearly basis, we see that there definitely was a higher number of exits for industrial corporates in 2018 than in the previous 2 years, in 2016 and 2017, where we had 18 and 16 respectively. In 2018, we saw 21 such exits, and in January there seems to have been just 1 reported at the moment. Maybe a few more will get disclosed. So just out of curiosity, Bernhard, how many exits? Because you guys have been around at Evonik since 2012. Well, you are heading since 2012, right? So how many exits have you guys had over that period?
Well, to date, we exited 4 companies. 3 of them were successful exits. The 4th company we exited is still alive, which is a good sign. But it from a financial perspective, it was not as successful as we had hoped. And maybe coming back to your earlier question, I think of course. In critical situations, when you go back to your board and ask for fresh money, you need to show 2 things. You need to show the ability to deliver strategic returns. This is important, but also our CFO is part of our steering committee, and the CFO question typically is not about strategic returns, but about financial returns. So I think this was when we brought the new fund forward. Of course, it was also very relevant to show that our activity does not only lead to strategic successes, but is also financially sustainable.
Mm-hmm. Right. So hopefully there will be more successful, financially successful exits to come to you and to other industrial, and not only industrial, corporate investors in the coming years. In addition to exits and deals, we also try to follow and to keep track of funding initiatives that may be relevant to startups from a given sector as we have defined it. So for startups from the industrial sector, we see that the number of funding initiatives which may apply to industrial startups has been stable in the 2017-2018 period. 37 in 2017, 38 initiatives in 2018. And when I say initiatives, I mean anything from a newly launched CVC unit through a corporate-backed accelerator or incubator or some other sort of initiative like innovation lab, open innovation, that sort of thing, through VC funds that have corporate LPs. So we do see sort of a stable thing happening there. On the dollar side of things, it seems like that there's a drop from 2017 where we had over 14 billion down to 4 billion. However, the 2017 figure, this should be taken with a pinch of salt, as the 2017 figure does include a fund backed by the Chinese government, by some Chinese corporates, that will be focused on Central and Eastern Europe, with a total size of 10 billion. So we do have kind of an outlier there, in a sense. So excluding that outlier, we see that we would have had more or less much the same dollar figure in there. Now, if we see some of the top funding initiatives in the sector, we see Sinopec Capital raising, actually funding and launching a CDC unit and equipping it with nearly $1.5 billion or equivalent. Sinopec is an oil and gas and chemical company in China. So inevitably, part of this capital, which may be used as a PA investment, may be used as VC investment, will go into promising startups from the industrial sector. So we do consider it here. Fortune Venture Capital, which is another Chinese-based VC, traditional VC firm, also raised a significant fund at $667 million, part of which will be focused on industrial startups. B Capital, which has been backed by which is related to the Boston Consulting Group, actually raised a $360 million fund, which part of which will go into industrial logistics and related technologies. Lockheed Martin Ventures, the defense company, it re-equipped its unit with $200 million. And then not to forget to mention again, Evonik raised its 150 million euro, which is about 170 million dollars at the time of writing, which is also here on this table. I'd like to take the opportunity to ask Bernhard quickly another question, because Bernhard, you do invest as an LP. You do take LP stakes in other funds, and I remember probably a year or 2 years ago you did take a stake in a fund that was investing in China, if I'm not mistaken. So how has that been going? What are the opportunities that you guys have been seeing in Asia, kind of thing?
Yeah, maybe to explain why do we do fund investments?
Mm-hmm.
We consider fund investments as our global radar, if you want, which allow us global exit in a fast way to emerging technologies, especially in regions or in technologies where we are not as advanced. So we now also have a presence in China since last year, but by the time we did 2 fund investments in Asia, we were not present there with an own office. So this was our first step to really, for a quick learning in Asia. And when we then felt secure enough, then we did the next step, which was putting a local presence. And the next step, and we are in midst of this, would then also be doing direct investments in China. A very similar scheme is what we also did in digital. We now have a digital resource. Our new fund also will have significant exposure to digital opportunities. But in order to acquaint ourselves and get a fast access to relevant opportunities, we did a digital fund investment in Germany. So we will continue to do fund investment whenever it comes to get fast access to either new geographies or embark in a very efficient way in a new area of interest.
I see. So finally, we also try to have a look at the government and university venturing scene and what's been happening there in terms of investments and innovation in on the industrial side of things. So the deal flow in university spinouts from the industrial sector has gone up from 2017 through 2018, as this graph clearly shows, almost twice, actually exactly twice. So there's definitely quite a few scientists in academia or promising students that are working on all sorts of things, from robots and drones through agriculture and precision farming to even new materials. So it does seem like the universities will continue to generate innovation that may become relevant and commercializable in a broader business sense, slightly longer term there. And on the government side of things, it seems like governments have kind of retreated in terms of backing industrial enterprises and industrial startups. And now, while I'm definitely not an expert on why that is, I must admit here, I do suppose it probably has to do with certain things related to the investment horizon, and how industrial startups are often you know, very capital intensive and take quite a bit of time to mature as investment. So that pretty much concludes all of my summary of the analysis of the sector here. Jim, I'd like to give the word to you for some additional questions you may have to Bernhard.
Yeah, sure. Thank you very much, Kaloyan, and obviously thanks again for preparing the data and such insights, and also particularly Bernhard for particularly the practical and expertise that you brought to bear for the webinar so far. Just a quick reminder to the attendees: if you've got any questions, do add them in. I'll be able to read them out. But if I start, Bernhard, just something you said right at the beginning. When you were thinking about some of the changes and transitions that we're starting to see, we're seeing some greater economic headwinds. There's obviously a greater degree of geopolitical risk out there. But as you think about the number of exits that you've had at Evonik, as you think about, potentially some of the sort of portfolio companies that haven't done so well as obviously within the corporate parent, there's always management change as people move into different roles. How do you start to weigh what you can control, which is perhaps what deals you invest in, against some of the more factors that are perhaps outside of your control, like whether those portfolios actually deliver, how much to support them, about the sort of management change, how much you have to educate the change, and then with any geopolitical or economic change, how you sort of position your funding to support those different constituents, the portfolio for new deals as well as follow-ons. How much do you think about those issues, and what to you is structuring an organization that can cope or have the resilience or flexibility to deal with those three primary challenges, which are perhaps more outside of your control than you would otherwise wish?
Well, when it comes to change, and if I understood you correctly, I think one of course of the learnings in our organization is a key critical situation in a corporate venture capital is to survive significant changes on the board, and especially changes from the CEO. I'm very happy to report that when I started in 2012, looking at the board composition and looking at the Evonik board composition at this point in time, we have an entirely new board, and I can say I'm in a very fortunate situation that I can say that this was the new board that really then approved a fund with an increased size of what we had before, And maybe also important to mention, within the new fund, we now also have the ability, in our first fund, we set typical investment size up to 5 million. In our new fund, we can write checks up to 15 million euro per individual company. And we also have gained additional autonomy for the venture capital deal when it comes to make quick decisions on early stage opportunities. So it's an increased fund size. It's also autonomy. I think what is really important to stay in close contact also with key stakeholders in the company and align your investment strategy very closely to the corporate strategy, and to make sure when you do investments that you do not end up with too many orphans and orphans talking about strategic orphans. So be very considerate of what you do. And please try the best. And this is also a very active portfolio management from our side. That the companies still maintain their strategic interest. And we even have companies in our portfolio where we were able to develop additional links, additional strategic perspectives for Evonik, which of course is also then opportunities for the company. So a very active portfolio management, and when we invest, we would typically assign one investment team member to really also help us and continuously work with the portfolio company and work with the corporates to make sure that we have full leverage on the strategic side.
Okay, that's interesting. Definitely the committed capital and the autonomy seem very important factors. Just one extra final thought. I'm mindful of people's time. We try and limit these sessions to an hour, so we're running a little bit over. But just one further follow-up. With that degree of autonomy in the committed capital now, do you do scenario planning to say, well, if we do run into a sort of an economic downturn, or there are other factors which force maybe some more of the independent or other investors in portfolio companies out, or they're looking, for a follow-on funding, do you identify the portfolio to say, oh, these people, if we get an opportunity, we would take a bigger stake, or definitely try and sort of follow on, and these, well, let's see how they develop, and these other ones, well, let's see if others will, pick up more of the slack there. How much do you sort of scenario plan for the portfolio company, given expected conditions, in terms of how the economy will look or how others react? Or is it very much, let's see how they deliver, and then we'll make a judgment, if and as we expect it? How much can you look ahead at, their expected funding rounds and cash flow, and then the likely reactions of some of your other syndicate members?
Yeah, they are two aspects playing into this. Whenever we invest in the company, we do what probably every good investor does. We develop a business plan, and we allocate additional resources for follow-on finance rounds. And in most cases, we are even a bit prudent and would allocate more capital than the companies think they would. So for us, an investment is not a one-time engagement. So we want to be a reliable partner for our portfolio companies, and reliable also means to be a partner then in subsequent finance rounds. This is also the way we set up our syndicates, or the syndicates we join. So for us, it is very important not to only invest in good companies, but also to invest in good companies with good syndicates. And a good syndicate for me is co-investing alongside partners who can bring value to a portfolio company, but who also have deep enough pockets to accompany a company also in the next finance rounds. And as we all know that all of a sudden, for whatever circumstances, you might want to, or it takes longer to the road to success. So we always are a bit hesitant when somebody comes and says, "This is my last dollar. I want to invest in the company." So we know there's irrational behavior from investors if they are at the end of fund lifetime, and we want to avoid this. At the same time, I think a good portfolio management is also to discontinue investing in companies where there's probably no success at the end of the road. So also, I think you need to be very considerate here and not continue finance companies who probably have little chance for success at the end.
Brilliant. Well, thank you, Bernhard. I don't think we've got other questions, and I'm mindful of people's time, but let me add my thanks once again to you and Kaloyan for running the webinar, and Kaloyan, for the final words from you.
Sure. Once again, thank you very much, Bernhard, for being here on our webinar. I suppose this does conclude this month's webinar. Stay tuned for next month's webinar, which is going to deal with the consumer sector and is going to be scheduled sometime in mid-April, most likely. So thank you very much, and have a good day or a good night wherever you may be in the world. Bye.
Okay, well, thank you, Kaloyan. Thank you, Jim, and thank you to everyone who attended the webinar. Have a good day. Thanks.